You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
And welcome to Volatility Views. I am Mark Sebastian, filling in for Mark Longo. He is on assignment at the FIA Quant Forum, so he's a little tied up. But don't worry, we've got a nice abbreviated but hard-hitting show for you today because, we lost the deep voice, but we kept all the intelligence. And with me is my usual partner in crime, Jared Woodard. Jared, welcome to Volatility Views.
Yeah, I think that we've got a license today with Mark Longo gone to really get into the stuff that we've always wanted to talk about and never have before. So I'm excited.
Me too. So with that, let's talk about the volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
And welcome to the Volatility Review. As you know, this is when we kind of discuss what's been going on. And I'll tell you, a rough week if you are a long VIX holder, rough couple of weeks long VIX holder. But one thing I was noticing is that, we're a good 20 points past the all-time high that we reached the last time we got up here. And the VIX is, a good 1.5 higher. So, Jared, what are your thoughts? I know you've done some research on this. What are your thoughts on a more elevated VIX with an all-time high in the S&P 500?
That's a great point. That's something that we were looking at this week, in fact. Just the notion that realized vol in the market has come down really dramatically, but premiums, even at the very front end of the curve, as you say, are still much higher than they were a month and a half ago before we had that that sell-off that ended in kind of mid-October. So it looks on that basis like premiums are a bit rich. One thing that I looked at this week was what the response had been around the world in not just U.S. stocks but in other developed market stocks, even in options on treasuries. And overall, it looked like investors had really sold premium, really gotten short volatility, or just brought it back down to normal levels based on the last year or so of data. So it looks like the premium has come out quite a lot, although, as you say, it's still elevated if you look at a comparison with S&P prices. And it may just be that these things take time to unwind. But it certainly sounds like, just based on some of the flows this week, that traders are looking for a relatively positive and quieter market into the end of the year.
Yeah, but you know where volatility has not fallen off has been in the currency trade and in gold and oil. It's been I don't know if you've been watching the options on the euro versus dollar exchange rate, but those things are flying for a kind of an average retail guy looking at the FXE options. Those are through the roof. I mean, this time 2 months ago, volatility on those types of options was near, 4 or 5%. This is an implied volatility. And now we have a situation where, the implied volatility options is more than double. Gold, GBZ, it's elevated. Oil vols through the roof. What are your thoughts on what's going on in the commodity space?
I think the temptation is to dismiss this, but these events are kind of sticking around in each of these cases, and so you do start to wonder how these things are connected. In the euro and implied volatility in European stocks as well was pretty rich coming into the week and remained bid pretty high even after the ECB meeting earlier this week. So it looks like some of that the added vol risk premium is anchor to bigger concerns than just the ECB meeting or just these short-term events. And I think that the interesting thing in the oil story is a similar kind of dynamic. A lot of people have been focusing on very, very short-term moves in the market, but premiums have been, pretty high for a while now, and it looks like we're getting a second. If this was a news cycle, in political news, how these things tend to cycle and die out, people might have been thinking about the oil story as something that would kind of get shaken up and then return to normal. But Saudi Arabia kind of doubled down on its position. U.S. shale producers really sticking to their guns, so to speak. And so it looks like the uncertainty around the fundamentals for the oil market could extend for quite a while, certainly at least until the OPEC meeting, and possibly even beyond that. And so I think that's why we're seeing the big bid for oil implied vol. And in gold, as always, it's hard to look at fundamentals for gold, but it's possible that we're seeing liquidation of some positions that people have had for quite a while. On a short-term basis, it looks kind of overdone to me. It looks like the reaction has been a bit extreme for people with very, very short time horizons, and so maybe selling some of this premium might be advisable. But you're right, though, that it's a situation where developed market equities have normalized in terms of the options markets, while fixed income, currency, commodity, not so much. And that's been the story, I think, for really the whole second half of this year. Situations where these other products that don't. Yeah, go ahead.
Here's a question for you. So, one of the things that volatilities obviously don't always correlate together, but my feeling is that volatility across markets correlates better than cross markets correlate to each other. So, when I see continued volatility in some of the currency spaces and commodities, it has me thinking that at a minimum, the 11 VIX is probably unlikely, and I would be more inclined to think that we're going to see above 15, 16, or 17 before we see the other half of 12 anytime soon. Thinking about your gold story and your currency story, have you heard about this whole thing going down in Switzerland with the franc and the gold standard? There's a group that got a referendum on the ballot that would basically force Switzerland to hold 20% of its reserves in gold. And, without discussing how silly that is for the Swiss, just because that would absolutely, the biggest problem that economy has, the perpetually strong currency. And in addition, what do you think that would do for gold? I mean, it's just kind of really, it's a really interesting under the radar story that I think could potentially really add some volatility to a lot of markets.
Well, at this point, I mean, it might be the timing might not be terrible, at least versus the last year or two of where gold has been. So maybe that would put a bid under the gold market. I don't know. I mean, it's a really curious wrinkle to the overall trend. But I mean, I like the question you raised though there, that are these markets going to correlate more so in the reaction involved than they do in the path of the underlying assets? And that's certainly, I think, the worry that a lot of people have, that even if growth stays strong in the U.S., that if the European policy response isn't timely enough or isn't scaled properly, that slower growth in Europe or possibly a bad outcome in the short term in China could really derail the world overall. And I mean, I think that at some point we're going to get to a situation where investors are going to be satisfied with a modest growth outlook for Europe, and obviously a little bit slower than trend growth in China, and then a really positive outlook for the United States. So it seems like at some point, once people are satisfied with those expectations, then we should start to see the path of the equity indexes potentially moving really differently, which is a big contrast, right? For the last several years, it's been such a unusually high amount of correlation, especially during down markets, even when liquidity is high and financial conditions are good. So I think that the decorrelation of the real divergence among stocks around the world is kind of the last holdout of the crisis for me. When we can start to see different growth outlooks and different paths for indexes, then I think we're kind of in a really new situation. And when we do see that happen, I think that you're going to see options markets start to become disentangled as well.
Here's hoping. Now, in the news, a couple of interesting things that I was watching. One, and both people related. They're launching the VXTYN, the futures on the 10-year Treasury options. And then, in addition, the stock is at an all-time high and is now trading almost $62 a share. Do you have thoughts on either of those?
Yeah, I think those are both really interesting. I mean, I think that I'm really excited for the new product. Being able to trade Treasury volatility with the kind of ease that people have become accustomed to in VIX products, it could potentially, it could be really exciting, could be really useful, I think, for a lot of different customers. Is that something that you think the folks you work with, or even in your own trading, that you might be using in the future?
I'd like to think so. The bond space is so weird and so much more upstairs. The only place that really a lot of the big bond houses play is, even like options that 10-year don't really trade. If they're going to hedge, they usually go to $0. So, I think that, I'm interested. I think there's potential that this future, if executed properly, could basically replace options on 10-year Treasury. I think that that type of play actually makes a lot more sense for it works even better for a bond portfolio than a stock portfolio, because I feel like the correlation of rates and their internal volatility is going to be a lot more solid than the correlation of the stock market and VIX. So I think that there actually could be some real use with this thing in relation to trading with futures, $0 and $0 options.
Right. As far as the I think the indexes the exchanges overall are one of the brightest areas of the financial sector in terms of an outlook for the near term. You've got a lot of different products that we didn't have 10 years ago that have been really widely adopted. Investors coming back into the market. Liquidity conditions are still very good, and the overall growth outlook is good. I think those are all situations in which the exchanges, broker-dealers, a lot of different parts of the financial sector could see some really good upside potential over the near term. And I think that with all the different products that the different exchanges are coming out with, they've learned a lot, I think, over the last several years about what works and what doesn't. And I know, at least for the CBOE, if they can find another product that has even a fraction of the audience that VIX futures and options have developed, I'm sure they'll be really pleased with that.
Yeah. You think CME wishes they paid the $25 asking price right before SIBO went public?
What's that?
I said, do you think CME? Yeah, so CME offered prior to them going public, SIBO $18 a share, and SIBO said, "We will do it for $25 a share." CME called and walked away.
Right. I'm sure they regret that, right?
You think so? You think so? Now, one other space that I wanted to look at real fast is the Russell 2000 and the RBX. Of all the stock index and the vol index, that is the one that really is the oddball. Call it youngest child syndrome. I come from a family of four. I'm the youngest, and I am by far the weirdest and most dissimilar from all of my brothers and sisters. I feel like the Russell 2000 and in turn the RBX are kind of like that when in comparison to the S&P, the Dow, and the Nasdaq. I mean, what are your thoughts on what's going on in the small cap sector?
Yeah, small caps have had a rough year. Even after this big bounce back in the last several weeks, just on a 1 year basis, the S&P is up like about 8.5% or so. The S&P is up about 16%. Russell's up about 8.5%. So it's really continued to lag, even though I think it's obviously more levered and potentially more responsive. And I think that could continue. The issue for a lot of investors who are looking to trade that differential has been problems with liquidity in the product, but I think that there's some things that they could do to attract some interest that just haven't happened yet. But as we said before, I think the use case for the Russell Vol products is really potentially quite strong. And given the divergence between the two indexes and the different paths they followed over the last year, there's I think still lots of potential there. It's just a question of finding the right liquidity providers and the right people willing to make it an active market. With a lot of these things, it seems like you kind of have to create the thing before it can really gain any momentum. It's not so much a build it and they will come as much as a make it an active and attractive place to be, and they'll come. And so, there's a big difference between those two things. But in the case of the Russell Index and the Russell Vol products, I think there's probably more potential than for some of the other new products we've seen in the last year or two. Although as we've talked about on the show over the last several episodes, we have also seen some activity in the VXST options.
Yeah, those are starting to heat up a little bit. I do think those will eventually get some traction as people figure them out. I really like them as an event risk type of trade, and we had 9 farms today, and if you were willing to go in with some of these VXST options into non-farms, you had a pretty nice day because they are just hammering VIX futures today. Even as the VIX, the VIX is down a little bit, but they've come in and given Nove and VXST a nice little shellacking. I'm looking out front and trying to figure out what could be a driver of VXT vol, and it's just not there. So that's a product where people can figure out how to play it from a short angle. It'll work really well, because right now the problem is everyone is just terrified of being short that thing into who knows what. It looks like the perpetual picking up pennies in front of a train. Mm-hmm. So, and there was
there was some activity in VXST this week that I'd pulled up. I thought I'd pass along to listeners. On yesterday, Thursday of the week, there's 3,000 contracts traded in the December 20 calls. December 3rd, 20 calls. And then today so far we actually saw some volume going as well. 1,000 contracts traded at 2 different strikes. I don't have all the data to see whether that was tied together, but those were the November 19 calls and the November or November 26th, 19 calls, November 19th, 14.5 puts. So that could have been a potential spread trade there, 1,000 contracts of each of those, and then another few trades with 300 lot, a 450 volume in the November 12 put. So it seems like there's been a bit more activity this week in that product, and so it seems like week over week we're seeing some fairly steady growth picking up there. But go ahead. Sorry.
Yeah. Well, what I was going to comment is, what I think has caused this product to take off. So if you go into the VIX pit and you go in the S&P pit, there aren't a lot of groups, market-making groups, that are kind of trading them off of each other. If some of the market-making groups and some of the kind of the variance guys and guys that are using S&P and VIX options start using the VXT in conjunction with VIX and SPX, I think that's what kind of gets it over the hump. VIX, that kind of works on its own. I think the VXT, if it becomes an integrated product, could become a really powerful weapon. I would invite traders to do some examining of selling straddles in the S&P 500 versus doing some sort of power trade, short put long call in a VXT option to see how a spread like that could potentially work out. I think that there might be some edge there. And with that, let's wrap up our review and commentary and move into the crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
Welcome to the crystal ball. This is where we're going to talk about our outlook and what's going on with us. So, Jared, I know a little shorter show today, but what are you watching for next week?
I think there's a lot of economic data coming out next week that could be market moving, but there's a few stories that I'm also watching with a little bit of a longer term focus going out to into December or so. One story has to do with retail and the risk for retailers into the holiday season of supply disruptions. This is something that it could become nothing very quickly, but we've seen this story play out before in years past, where labor negotiations at the ports in California, break down, and you have supply problems. There's already been some delays this year just for the sake of insufficient capacity at the port, where you have these mega containers, these ships carrying much more than has ever been done before, causing really large delays. There's been a trucker strike that's caused some additional delays, and all those costs can pile up really quick and put pressures on margins. So we're watching that pretty closely for any kind of reaction or developments, because I think there's some real potential for retailers with exposure there to feel the heat into the holiday season if that story takes a bad turn. And then the bigger risk scenarios that I mentioned before, I think are still fairly urgent and could take a bad turn at any point if the data starts to suggest that. So I think keeping an eye on pricing with regard to events in East Asia, both the China growth story and Japan's experiment, I think there's a lot of potential in those markets as they move and as data comes out to trade around them for the short term and to position for long-term risks. But in terms of vol and VIX and sort of bread and butter stuff, I think that the market probably has it right for the very short term that economic data in the U.S. is so good and the outlook is so positive that being long volatility or even neutral here doesn't seem like the best risk reward. I think that the short vol carry type positions look like the most attractive way to go for now.
Did you guys have any thoughts or research out on the Sears news? Speaking of retailers, Sears news that them potentially turn themselves into a real estate investment trust. And because I don't know if you saw the stock was like $10 today. I was wondering if your guys had any thoughts on that stock.
Yeah, I haven't seen anything on that come out yet today, but definitely something we can keep an eye on.
Yeah, we'll be waiting in the wings. Yeah, and Jared, I tend to agree with you. The other piece of news I'm watching is the potential for Ukraine to heat up again. There was rumors of tanks and howitzers moving into the eastern Ukraine. That could be the other piece that heats markets up again. So with that, Jared, what's going on over at BCG Capital in the next couple of weeks?
Well, we've got a couple recurring publications that we put out, but I've also started a new semi-daily, shorter-term note looking at higher frequency economic data that comes out, any interesting stories or very shorter-term trade ideas. So we came up with a piece as well on China this week that looked at some Chinese companies listed in the U.S. that have earnings coming out, some trades around those earnings setups, and that's something that we kind of screen periodically and update the data for. So we're getting a lot of traction with that kind of work. It's really actually kind of rewarding to be able to look at what clients are interested in and develop some more in-depth work accordingly. And so that's a big part of the work. I spent a lot of the day today actually helping some people look at different risk scenarios as they try to hedge their portfolios for the year ahead. And so that's what's going on in our neck of the woods. What about things at Option Pit? What's cooking over there?
Just read our blog. We've been doing, we've been writing a blog every day. We try and do analysis. Give it a read, optionpit.com/blog. So with that, I will close this shortened Volatility Views and wish everybody a great day. And Jared, thanks for being here. And Mark Long will be back with his deep, intoxicating voice. And will I and Jared have a great day, everybody.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.